what would stop my evil twin from eavesdropping on this pitch? I'm going to take $1 million, run up to Stanford, find a couple really bright AI researchers there. Here, take a semester off from school. Here's $1 million. Build this for me. Then I'll hire a couple really sharp biz dev guys and go sell it to accountants. And in 3 months, I'll be where you are. I often ask them, so why are you worth $20 million today?
David Mandel built, operated, and exited 4 successful businesses over 28 years. A serial entrepreneur turned investor, he has now invested in over 500 early-stage companies, hunting for the geniuses inventing the future.
Some have quasi-good answers. Many really don't have a good answer. Sometimes it's the guys that are at least likely to be able to do it. Let's say 2 immigrant co-founders, strong accents, no network here, barely speak the language. Despite that, they don't think about any of that. They just get it done. Between Gen AI and now agentic AI, I'm seeing all these startups that all seem like they meet all my requirements, and yet I'm not writing checks.
Welcome back to another episode of Built for This, Stories of a Maverick, where we dive deep into the stories, mindsets, and moments that define the Mavericks building the future. Today, I'm joined by David Mandel, investor, entrepreneur, and managing partner at Emerging Technology Venture. With decades of experience backing transformative technologies, David's career bridges the world of finance, innovation, and impact. He's helped scale companies that are redefining industries from clean tech to AI and has an incredible perspective on where venture is headed next. In this episode, we're going to explore David's journey, how his early experiences shaped his investment philosophy, what he's learned about resilience and leadership along the way, and his view on how artificial intelligence is transforming the venture landscape. Whether you're a founder, investor, or just obsessed with how bold ideas become lasting change, this conversation will leave you thinking bigger and leading with more intention. So let's dive in. Welcome, David.
Thank you, Jenna.
Awesome. Well, I love to always kind of start at the very beginning and kind of understand a little bit more about sort of what got you into this world and a little bit of, if it was you were born and bred to be in this world or you kind of fell into it by accident. I love to kind of understand, we'll call it the early days of how it all began for you.
Okay, I'll try to give you the short version because we don't want to spend all day on that. But the parts that are relevant is back in college, I was a double major of applied math and computer science and was actually fascinated with AI at the time. It was just a little too early. And that was, grad school was 1989, 1990. So it was early days of PC. It was before the internet, and what was available technology wise just wasn't there and eventually got the master's degree, passed the got the master's degree, dropped out of the doctorate program, went into business, and kind of forgot about that world, got all into building and exiting 4 businesses over almost a 28-year period around, and all underwriting businesses, balance sheet companies around insurance and finance. How I got full circle to where I am today back into technology is if you jump to around 2011, 2012, that's really where I woke up again. Because in my day job at the time, I had 2 big companies at the time. One was a subprime auto lender, indirect auto lender. So we were financing cars. And the other one was an auto insurance underwriter. So we were insuring cars. Yeah, so a little bit of a theme there, but happened to be both auto related. And both were growing and getting to a point where there's a lot of data. And we had always looking for an edge in underwriting and internally on all of our processes and automation. And, I used to really say, especially on the insurance side, it was all B2B and it was high volume. We're insuring over 1 million cars on the road at any moment. We're writing over 30,000 new policies a month, during our peak times. So it was a really high volume operation and very well automated. And we're always looking for better tools. So we are constantly talking to data vendors and other technology vendors who can provide us solutions for better automation and better data, better insights. And, most of the time it was the traditional vendors. And then, around, as I said, 2011, 2012, I started to see a new breed of vendors. Were coming to us. They're vendors we haven't heard of before, and they are what you would call now tech startups. And they were showing me things that sounded too good to be true. It sounded like magic. And they would do a POC. They came in, for example, take a massive amount of our unstructured claims notes. Claims notes are just messy text, and take a massive amount of these unstructured claim notes and bring us back some true insights. And it's like, wow, that was just a, and now we would call that combination of natural language processing and machine learning. And but to me, where technology was, I was unaware of what was going on in Silicon Valley, to be honest. I was in my world attending like claims legal conferences and things about, the future of auto finance and all those kind of things. I really didn't know where technology was in general. I was, in my own world of our businesses that we ran. So I started to see some of these vendors that got really excited by what they can do. And then it's like, okay, that's a lot of like what I wanted to work on, 20 something years earlier. And so that woke me up to say, let me see what's out there. Started attending technology conferences, primarily, in Silicon Valley when there were different conferences, and then started to do some angel investing and join some angel groups. And that was really where I started to go down that rabbit hole, because the more I got into that world, the more excited I got. And the more interested I was in that, the less interested I was in my day job, so to speak, of running the two businesses I owned at the time. So I love building things. I love the product side. Running them once they're bigger is less fun for me. So, eventually it becomes less about the product and more about compliance and HR and legal and regulatory and all that stuff, and relationships with vendors and all those things. So the startups was just an amazing world I wasn't even aware of. I didn't even know really how venture capital worked. I knew how private equity worked, and we had some dealings with private equity firms, but I didn't really know about the early stage startup investing and angel investing and all. It was a whole new world to me. So I got excited, kind of went all in on that, started spending a lot of time in those different worlds of both the angel investing and the VC world as well as the technology world. And to a point where by 2013, I was spending more time on that and less time on my kind of day job, and said, I want to really do something in technology. I'm not sure what yet, but I got investment bankers involved. And while even though both businesses were doing well, it's like, this is not what I want to do the rest of my life. I want to do
Yeah.
something in tech now that where it is. It seems like just the world's changing right now there, and I want to be part of it. Got investment bankers, had eventually exits for both of those businesses. And by 2015, I became a full-time angel investor. So I got out and started doing massive amounts of angel investing, wrote a lot of small checks. And then by 2019, a partner and I decided to make a small fund so that we can collect some of the other people who from my prior life, by then I was out for several years from the industries that I was in, and all my former associates were kind of curious what I'm doing. I would always tell them about angel investing and technology, and I'd be all excited. And they'd be like, that's really cool. Let me know next time you're writing a check. I'll co-invest with you. And enough people said that where it's like, I really want to institutionalize this a bit and make it into a real business. And that's where we formed the fund. And that was Emerging Ventures Fund One back in 2019. And it was really just 20 something LPs that were all basically people from our networks, from our former life, that each came in, and we aggregated our money and were able to write slightly bigger checks and have a little more formal process. And that, 6 years later is our third vehicle. So we're on fund
And I
three.
just want to pause there because there's a pretty big decision to, everybody building a business, goes in with the intent of, ideally there's either going to be some major event at some point. You sell it, you get acquired, whatever that might be. And I'm curious for you, as you start to kind of have almost what was really exciting to you, when you were younger, sort of like come full circle back into your life, kind of poke at you a little bit saying, hey, all this stuff is happening now. You can come kind of play in this world versus, these businesses that you've been building and creating. And was it tough for you to walk away? And I find, because sometimes my experience working with founder-led companies is they want to go play with other things, but
Yes.
they want to quite let go of control at that point. So I'm just curious of sort
Mhm.
of how you looked at it and how you
Yeah,
handled it at that time before you
that's
made that big decision.
very good question. It did take me a couple years to come to be comfortable with the fact that I'm gonna have an exit. I was trying to balance that. I was trying to keep my roles as CEO of both those companies and still do a lot of stuff on the side. At some point, I even toyed with the idea of bringing in other CEOs because I really wasn't enjoying anymore running the business. I want to spend more time talking to startup founders and being involved in tech, and was starting to, you know, see the economy between enjoying that part and enjoying less my day job because of that. And it's like, okay, I don't want to spend the rest of my life sitting in this office running these businesses, dealing with the day to day of it. So the first thought was really to hire CEOs to run those businesses for me. And the problem is that they were balance sheet companies. They were underwriting businesses. We had, let's say $100 million worth of line of credit that I had personal guarantees on and so forth. So it was more than my entire net worth that I was guaranteeing. And it's like, I would not be comfortable handing that over to someone else who was a hired hand at this scale and to continue to scale it when I'm all in on it and it can take me down and yet I'm not involved. That would be scary. So I really realized that, at some point, it's like, I'm either going to run them or I'm going to exit. There is no in between. There's really no, I mean, I could have shrunk them, but that didn't feel right either. So it was, yeah, because everyone was like, okay, you can just bring, hire a CEO. We already had an executive team on both. And I didn't have,
Yes.
I was really involved in decisions and involved in keeping my finger on the day to day, but I wasn't really in the operating role. I was a CEO role. Not, I had the equivalent of like CFOs and COOs and, people running each of the units, chief claims officers, chief underwriting officers, that
Yes.
ran each of their units. But I was still really involved in everything and decided to get out. Decided it's like,
Yes.
even though these businesses make good money, I have enough of that. I really don't want the stress. I think the stress of owning those businesses and not managing them would be worse than being there. And
Yes.
I started to think about what would that feel like to not be there. And every time I would take a few days to go to a conference and be away, I still felt uncomfortable. So I decided that no, I'm just going to do it. I'm going to get out and let other people who really want to run that. And they're kind of growing anyway. They kind of needed deeper pockets. They would have been better off in deeper pockets that can support them financially. I didn't want to bring in, because initially the idea was to bring in private equity and partner with private equity, and that was almost happened actually. But they would really want me involved for several years. And I was like, if I can, I'd rather just exit, hand them off. Doesn't have to happen twice. I don't need the whole private equity and then the next step. Let's just hand it off, even if I get less. But we'll have a clean exit. The current teams can go to a home that wants them and that can help them grow. And I can move on and focus on what I want to focus on. And that was a 2 year mental process, really. It wasn't like one morning I woke up and say, I'm going to do this. So you're spot on where
Yes.
it was tough from being all in on a business to slowly getting interested in something else to eventually saying, I can't do both and I'm going to exit these
Yes.
day jobs because this other thing that I'm doing, I like a lot better right now. And that's what I want to spend my time on. And I have to,
Yes.
hand my babies off. They've kind of graduated, they matured, they're going to move on and move out of the house and have their own life.
Yeah, I think that's so important too, because I think there's a lot of struggle around. I love that you touched on, hey, we almost had, a deal with private equity, but usually it's always okay. We want to keep you at the helm then for whatever it is, 5 years, 10 years, and then we'll exit you out of it. And I think that's really important, just even from a leadership perspective for people listening, of like, knowing when to walk away and knowing that even if you decided that you'd still be unhappy and then you're stuck in an agreement of
Yeah.
where you're back in a leadership position. And I think, when you look at sort of moving from that owner operator role into, the investing world, and you mentioned I didn't really know what was going on in Silicon Valley until I started kind of, jumping in and learning. And talk to me a little bit about your experience starting to invest and sort of look at deals and how you approach that, because I've heard some, there's some real glamorous stories and then there's some not so glamorous stories.
Right.
When you enter into that world and just trying to understand that ecosystem and how to move within it to ideally have a successful outcome versus kind of taking advantage of.
There's definitely adverse selection, meaning that the insiders kind of see all the good deals, and when you're new and not well connected, you're seeing kind of the leftovers. So you're not seeing the best deal flow, and that was definitely true for me initially because you're going to all these events and there's always startups pitching. There's conferences, they're talking about tech, but there's also startups there that are pitching. And in the beginning, you don't know any better, or at least I didn't know any better, and everything seems amazing. So they're all enthusiastic founders, really smart people, and really excited about what they're building, and it all seems amazing. You want to write them all checks. Uh, and so there's a learning curve like anything
Yeah.
else. And in this case, I learned with my own money. I got to write checks. I didn't go out there and raise a fund day one and say I'm going to invest other people's money. I actually never planned to ever invest other people's money. That kind of was a strange evolution. But I started writing checks. And then, eventually you go to hundreds of these events and see thousands and thousands of pitches and eventually you realize that they're not all so amazing. It's like, this looks great, but you've seen 10 other people doing something similar that might be, doing it in a smarter way and moving faster and have better traction than, so when you see a new deck, it's like, we're revolutionizing X, whatever it might be. And then you're in your head, it's like, no, you're not. I've seen 10 other people in the last year that are doing this better. Uh, so you start to get a little jaded after a while and you start to, realize that, let's say today with agentic AI, which is the hottest new topic, everyone's saying, oh, we're revolutionizing whatever it might be, dentistry. And they have software for dentists to replace all their, make their life 10 times easier and whatever. And you're like, okay, but you're like the 10th person in 2 weeks that's telling me that. So, yeah, dentists can use AI just like everyone else needs AI, but they don't need 100 choices. And there's nothing special about yours. Uh,
Yeah.
so, that's really the evolution you go through. You start out, to answer your question, really, you start out, yes, making a lot of mistakes. And I just jumped in and started meeting people and eventually writing some checks and, going to more events and finding out which events I like, which events I don't like, which organizers do a good job of bringing in really top-notch startups, at least by my standards and my opinion of what was interesting to me, and which didn't. And you kind of call that after time and you say, okay, this one I'm going to follow and go to everything they do and get to know them better and maybe get involved in their program. And this one, maybe not so much. And you find all the accelerator programs, the incubator programs, the university programs, and you see which ones you like and which ones resonate and which ones don't. And you just double down on the ones that do, and you get involved. You become mentor to the groups, or come in, do early investor office hours with some groups where you really say, okay, this is a group that I like what they bring. They have whatever, 10, 12, 20 new startups in every quarterly batch or every 6-month batch or however each program operates. And it's like, those seem to be good for me. And, there'll be one or two that I'll like, and I'll go in every time, look forward to their batch and find the one or two I like and maybe invest, maybe not,
Yeah.
and ignore some of the other organizations where I know that I don't like their deal flow. I
Yeah.
don't like the way they run their events or whatever it might be. And I just ignore everything from certain groups and do
Yeah.
more of the ones I like. But that was a process. I started angel investing somewhere around 2011, my first feature, and more seriously 12 and 13, and then full time by 15. And now we're in 2025. So it's been something like 14 years. So I feel like a veteran now in the industry. And of course, a lot has changed. COVID has helped a lot in access because anything that was previously local and in
Yeah.
person, when it went to Zoom for the events, it meant like, okay, there might been a whole list of events I've been meaning to go out to. Maybe they're in Boston, maybe they're in New York and wherever. And then it's like, okay, yeah, now maybe next year. And you kind of pick and choose because you can't be flying all around the country all the time just to attend pitch events. There's only when they went on Zoom, I was able to check them all off my list and check out every one of those events. And new ones popped up that were completely virtual from day one because it was easier to do that. And so it changed all that. And now through today, a lot of things are either virtual or hybrid. We have a trend of going back to some in-person only events. And I've been flying around a bit more the last 2 years or last 3 years probably already. In 2022 already, there started to be a lot more events that went from live to virtual to then hybrid to then in person only. And, if it's a hybrid event and you're attending it virtually, it's not quite the same. Although, you if it's the start pitching there, there's usually good software that helps you play matchmaker and find the ones, and then you set up Zooms with them or whatever. But it's different than being there and having a
Yeah.
desk there in their investor lounge or something, be able to just meet face to face, like a dozen a day for 3 days straight of the ones you selected that you want to have meetings with. And so that's
Yeah.
awesome. So I go out to events all over the world. From Toronto and Vancouver on the Canada side to big events to, occasionally New York, occasionally Boston, quite often up to the Bay Area. I'm in Los Angeles. So
Yeah.
there's a lot here. Actually, 2 weeks ago was LA Tech Week, and there was 284 events that was on my list, and I had to narrow it down to like, maybe 5 or 6 a day that I want to go to, in combinations of investor networking and startup events and some tech specific events in certain like deep tech areas or wherever they just want to learn about certain tech or see what's going on. But it was amazing here. But because it was back to back San Francisco Tech Week and LA Tech Week, and I saw a lot of redundancy between the two, I chose not to fly up to the Bay Area the week before and just prepare my week to be efficient for the week when it was down here.
Yeah. And I'm curious, I mean, I even think from even an operational perspective, there's just a big draw for people to connect in person. I think there's a lot of like virtual fatigue and people are trying to, get people in person and connecting. But as you started to look at all these companies and then, start to prioritize which events kind of made sense for you, which networks made sense for you, when you start to look at deals, for you, what are your kind of maybe your like your core guidelines or sort of investing ethos that you look at from what you're looking at in the entrepreneur to like the company and how they're moving from like a this seems credible and I want to kind of, you know, partner with them.
Yeah. Very good question. And it took me a while to figure that out myself. And I say I'm an underwriter by nature, so I was trying to figure out how do I underwrite startups. And
Right.
in the beginning, I wrote too many checks to startups that were a little too early. And it seemed like they had good early traction, but then they weren't able to scale that. So what I focus on now, especially, I only invest in business to business and B2B tech startups. So they're helping businesses solve some kind of challenge. They're making and selling to business, especially to enterprise, can be a long, tedious process. It could take months and months and months to close an actual deal with a major, say, Fortune 500 company and then to implement it. So you
Yes.
because you have to get different stakeholders there involved and so forth. And I've been on the other side of that. I was that enterprise that these startups were selling to in the past. So I understand the procurement process. And it's why I invest in this world. But in the beginning, I would get excited when they had an MVP and they had some early great logos, maybe a bank and maybe Pepsi or whatever, Procter and Gamble or whatever. And but it turned out that it's always through a warm intro that they had. And a year later, you'll follow up with them. You write them a small check and you stay in touch. And a year later, you're like, "Where's the traction? What's going on?" And it's like, turns out they're still trying to figure out their go-to-market strategy. It's easy to get those first few through their network, and then they exhaust their network. And
Yes.
then having a repeatable, scalable sales process
Mm.
is not something that's as easy to get. And so that's now what I look for. We specifically that if wait for them to have basically figure out their go to market. So they have to have a repeat, and I articulate that as a repeatable, scalable sales process. They have a sales funnel, a way to build that funnel and keep it nurtured, and then a way to close those deals systematically. Something that doesn't depend on the network of the founders, because the network of the founders is not scalable.
Right.
And that was the mistake I was making originally, getting excited about the product and the early traction. And it's like, oh, this is great. Oh, and Citibank's using it. Oh, that's amazing. Okay, if it's good enough for them, it'll be great. And it turns out it's like, okay, you got the one Citibank because maybe, you went to school, you were roommates with the CFO, which I, and it turns out that that's how you got that deal. But
Yeah.
that's not repeatable. You have one of
It's
those.
like it helps to have the connection in the in always,
Yeah.
but then
So
what
it
happens
turns
after
out that early traction is easy because they always
yeah.
have something. So that's how they got that early traction. You see now over and over and over. I see that instantly. I mean, a lot of them have no traction, and that's horrible. But those that have the early traction, the first thing I would ask them is like, "Oh, I see you have Citibank." I'm just picking out Citibank. I happen to be,
Yes.
but I see you have Citibank as a logo on your deck. Okay, that's amazing. How did you get that deal? You're a brand new startup. Why would they trust you? What's the deal there? How did you find them, or how did they find you? And the truth eventually comes out like that. Like I said, there'll be some kind of interesting story. Like they have some warm connection that is high enough up the food chain there that was able to get them in, and they didn't go through the normal procurement channel. They didn't cold call on them and get an appointment. And that's where it's like, okay, yeah, when you figure out your go to market strategy, let me know. And a lot of times they never do. And some of these businesses, the other lesson I learned the hard way, that a lot of really good businesses are not meant to be venture backed, because they're not meant to be venture scale kind of businesses. And they're almost more like a professional services business disguised as a software business and a SaaS. But you're really, something that you should build slower. And maybe you don't want venture capital, even if you could get it. You want to build something slower, and it's in your nature and the nature of the product you're building to build this in a meticulous, slower way and grow, 20, 30, 40% year over year. But you don't have to grow 300% year over year and pour tons of money in to keep having to raise more money to grow faster to hit those metrics. And maybe you shouldn't. And maybe you
Yes.
should go out to some angel groups and raise like that $1 million you need to get you over the hump to finish developing everything and make it robust and get
Yes.
the sales team built, but not raise venture capital. Be once and done with a small raise and with investors who are expecting you to grow this slower, and not go out and bring on VC because it's not meant to be. And a lot of
Yeah, it
times,
reminds me of the book, like, Good to Great of, like, sometimes, like, it's not something that has to have this, like, 2-year rapid scale and, like, everyone gets excited about it and it goes. Some things are, like, built sustainably, chunk by chunk over time, and you build this really great company. And I'm curious, I know obviously, you learned, okay, is the sales, process repeatable, scalable? Do you have a go-to-market strategy? What does that look like? I'm curious outside of, we'll call it the product and the service and their execution, is there anything you're looking for in terms of who's leading that company and what you've seen from either like a personality or trait perspective where those match and you kind of look for those as well?
yeah, it's more about show me, because
Yeah.
it's those who can. It is all about execution. It's show me. It's the no excuses kind of guys, the guys that just get stuff done. And you can call it grit, or you can call it, but there's some people that do a lot with a little, and they just move, and you don't know how, and you feel jealous because, like, I would still be thinking about doing it, and you already just did it. And it's amazing where they can bring together a few people and figure out a way to build a product while simultaneously getting on the phone and getting out there, figuring out how to get customers in to try it. And it feels like they have endless energy and just move so fast. And I'm doing so many things at the same time with so little resources and not making excuses. I hate the guys that have, oh, we're raising this money so we can hire a team and do that. No, not interested. It's like, I can't do it without, yeah, I would have done that, but we don't have the money to do that. It's like, no, there's, because
Yes.
I've seen the many, many other guys that just get it done. They figure out a way. They make it happen. Don't have a victim mentality. They have a let's do it mentality. And sometimes it's the guys that are even the least likely to be able to do it. Let's say, without using any particular example, let's say two immigrant co-founders that, they came here for college. So they were 18, 17, 18 when they came here, spoke very little English, have strong accents, went to university. They're obviously smart. They were able to get into great schools in the US being foreigners,
Yes.
but they have nothing here. They have no network here. They barely speak the language. They have a hard time on Zoom because they have a really strong accent in English. And yet, despite that, they don't think about any of that. They just get it done. I would see some of them like have government contracts and have all these things. Like, how the hell did you get the US Navy to pay attention to you and give you a $1 million contract? I wouldn't know how
Yes.
to do that. And you pick up the phone and do it. It's like, I just called everybody and did it and went online and figured it out. And it's like, do you have a connection? Did someone connect you? Do you have a friend? It's like, no, I just reached out. I just called, figured it all out. And, you know, they hire people, they build products, all in nimble ways, low cost ways, and efficient in time and money, where they're not like writing memos about it and building prototypes for it. They just go out there and build something. and then get people to pay for it and get their attention. It's like that gets me excited. I love that attitude.
Yeah, that comes like, the word that comes is just, like, that relentlessness, like, I'm just gonna not stop till I get that person on the phone who's gonna get me what I need, and I'll figure out how to explain it to them, or if they want something different, I'll fix it and bring them what they want, and we'll, like, make it
And
go.
that combination of being academically smart, technically really great technically,
Yeah,
which you often think of as the more reserved kind of nerd kind of guys that will be in that. And yet at the same time, they're able to also do this, go out there and get on the phone and move and get things done. That's an amazing combination. When I find those guys, and I recognize that through what they've done. I can't look at a founder, all of these, if they would have come to me like 6 months earlier, I would have said, no way. They're the least likely to succeed. And if they just came to me with an idea, if I look at the founder's background and so if I look at their bio and the idea, I'd be like, I can't tell them apart. They're all smart, and the ideas, I don't know what's going to sell, what's not. Show me. Show me you can build it. Show me you can get the right people to pay for it, and so show me you can sell it, and show me the right people are willing to pay for it. So that means you have a product that the customers want, and they want it so much they're willing to gamble on the startup to get it, as
yeah,
opposed to an established company. So they can't get it from their established channels, that they're willing to actually bet on you because they need that so much. Then I'm
yeah.
excited.
Yeah. I love that. And so as, your angel investing evolved into, okay, now I'm going to do a venture fund and this is going to be outside of me and I want to bring in partners, was it organic or was it, you kind of met somebody, you're like, hey, why don't we do this a little bit differently and actually like make a venture fund and we get to do, our first fund and let's see how this goes.
Somewhere in between, because there was enough people from my prior life that I would catch up with, and I would tell the story of what I'm doing now. They're like, "What are you up to?" And I would say, "I'm tell them like I am to you, be excited about angel investing in technology, and tell them where technology is, and tell them about the angel investing I'm doing and all the events I go to." And they didn't necessarily want to do the work, but they wanted to write the checks. They're like, "So that's cool. You're investing. Oh, okay. I would have done that. Like, tell me next time, if you're doing all this work and you're finding them, the next time just tell me, I'll write a check too." Because I tell them, like, I'm writing, and there's always the stories like, I'm writing relatively small checks. I wish I can write bigger checks, but, you know, it's a long 7 to 10 year cycle. I need to pace myself or I'm going to run out of money. And, I already had, by 2019, I probably already had like half of my net worth into early stage startups. It was way more than I ever planned to. It wasn't very smart as far as personal diversification, but I kind of started, I was writing more and more checks and they don't come back. It's the exits take a long time. So, and it's a completely illiquid asset class for the most part. And
Yeah.
then, so that's where I said, okay, the answer really is, I had enough of these. Let's say I had over 20 people who said they want to invest with me, where I said, okay, let's do this. Let's make a small fund, invite them to come co-invest with me. And the first fund still was about a third my own money. And it was the idea of like, okay, I'm going to keep writing. So I'm going to put in about the same amount of money I used to put into every startup. I can write 3 times the check size by having other people's money sit there with mine. And that was really how the first fund was born. And that worked out. And then I raised 2 years later. So that was 2019, 2021. We raised our fund two. And that was about twice the size. We had those people kind of double down and had some referrals and other people come in. I still kept it small and with people I know. And
Yeah.
I don't have that scalable go to market myself. I did not bring in any institutional investors. I still wanted to feel like my angel investing, just allowing others to co-invest with me passively without having to do the work and just have my
Yeah.
partner and I do the work. I'm basically the face of the company, and then my partner helps with due diligence on the back end. And then we have everything else outsourced.
Yeah. Did your investment ethos change a little bit since you could write bigger checks, looking at a little bit more into those kind of later stage companies? So those exits were going to come in a
Yeah.
few years versus like,
Right.
10 plus
Well,
out?
we're still writing. That's a really good question as well. We're still writing small checks on the grand scheme of things, and rounds kept getting bigger. So the answer is no. We're still only at the seed stage primarily, and we now actually we do shy away from the earlier pre-seed, like I mentioned, because I need that traction. But I'm focusing on seed stage, kind of later seed within seed, but still seed stage in particular. And the rounds are typically, like to give you an example, the rounds are typically from 1.5 million to about 5 million in size. That's a typical seed round. And our checks are up to 500,000 for our initial check. And so we're still small. We're still at most maybe writing a third or much less of the round. I wish actually I want to be able to write $1 million checks, but we're not quite there yet. I didn't want to go out there and have to raise the money in order to do that. So our compromise was to stay here, write these $500,000 initial checks and keep some reserve in the fund to follow on. We could double down on the startup on their next round if we like where they are, and we've done that.
Yeah.
But that's where we are. So we're still a really small fund, writing small checks within the bigger picture. Now, you just had
Yeah.
Sequoia just announced they just closed two funds, 950 million total, 750 million for kind of Series A and 200 million for seed. So, we're competing with that. And, the Series A doesn't make sense for us because they're often raising 10 to much more million, and my 500,000 doesn't do much there.
Fair. And I think that's always the interesting part that I think some people, again, coming back to do you need to be venture backed or not? And like, how much money do you need to scale? And founders being really thoughtful about that, but also, making that strategic decision to either, prolong it or to say, again, no, we don't need this. Let's look at getting money a different way. And I mean, now, you touched a little bit on, AI and that kind of, coming around and everybody's got something for somebody in an industry. And I'm curious, from where you're at, how AI is, changing how venture works or how you're looking at it from even like a deal flow and like quality and sector focused perspective.
Yeah, that's a loaded question. There's several angles to it, so we can try to
Yeah.
unpack that. Eventually, every business is going to be an AI business, just like every business is like an internet business. You can imagine running a business today without computers and without internet. So the same thing by now already. Every business, in one way or another, is using AI. Some in a more sophisticated way than others, but they all are using AI. It doesn't mean they're necessarily an AI business, but they use AI tools. And there's pressure for startups today to try to be AI first and be an AI startup because that's where the money's going. That's the exciting new technology. Last year, it was all about generative AI and using the APIs from, the open AIs and Google and
Yeah.
everybody else to create fancy interfaces that behind the scenes called those APIs and did something industry specific. This year, it's all about agentic AI because the industry's matured a little bit. That it's not enough just to generate stuff. You need to actually get work done. And agentic AI is really providing almost like virtual workers
Yeah.
as a service and task specific or industry specific workers virtually. So agentic AI is almost the ultimate AI. And Y Combinator in their prior batch, not the current one, the batch that graduated in June, I guess that was the spring batch of 2025. I wrote a blog post about this in June when it came out. Basically, they put out a call for agentic AI startups, and YC is pretty diverse. They have everything from, life sciences, like, medical devices and, pharma, biotech to consumer devices to e-commerce to marketplaces. So they have a very diverse global set of type of startups they invest in. And yet within that, half the batch, literally half the batch was B2B agentic AI startups. So it was agentic AI for some vertical of some industry, and doing work that otherwise humans would do, whether it's specific tasks or completely replacing certain functions. And it's where you take these virtual agents and you give them access to your systems. You create them as an employee on your system, and they can go in and they can, for example, read an email and then process something, trouble and reply to it, put
Yeah.
information in the system, update information. I can email them, say, please update my address. Here's my new address. I moved. And they would take that and go into the CRM and update the address and reply back saying, okay, I updated your address. And they have a persona and they do it. And, it's replacing something a human would do. And that's a pretty simple example, but that's the idea of across the board, they're doing that. it's all exciting, it's interesting, it's easy to get early customers for that because everybody in every industry wants to try it. So, if you're doing that for lawyers, you're gonna get lawyers to try it. If you're doing it for accountants, you're gonna get accountants to try it. So, my dilemma as an investor is it kinda turns everything upside down on its head because it's so easy to build. The tools are there. The foundational models are providing you APIs that you can call to do all this behind the scenes. So you just have to create a pretty interface and maybe train it on some industry specific terminology or some license, some data that is specific for like, say law or accounting or whatever, train it on that so it does something 100% correct for a certain industry a certain way. And then once you do, or and build the integrations with the core systems so that, whatever CRM, if they're on Salesforce, it can be in the Salesforce ecosystem or whatever. If, they're on HubSpot, it can work in HubSpot, it can work in their email clients that they have, whether it's Microsoft 365 or something else, and Gmail. And once you connect it to everything, then it's easy to get traction. You can build these now in weeks or months, and that can be pretty, and you can get traction. So that whole idea of, I would say, show me you can build it, and show me you can sell it, and show me people willing to pay for it, almost doesn't mean anything anymore for these because they all have that. Because it was so cheap and easy to build, and it was so easy to get the early traction because it's exciting and everyone
Yeah.
wants to play with it. So it really threw my model upside down, and I'm still trying to
Yeah.
figure that out. The last year and a half, basically, between Gen AI and now agentic AI, I'm seeing all these startups that all seem like they meet all my requirements, and yet I'm not writing checks because I know yet that this is great, but there's too many of each. It's too easy. They all claim to have a moat or first mover advantage, but I don't really see it. And most of the cases, most of the time, I don't see the moat. If you built this in 3 weekends, or if you built your MVP the first time in 3 weekends, got some early users, and now you refined it a little bit, and 3 months later you're raising a seed round, and you have already 200,000 in ARR, and you have 50 clients using it. It's like great, but is this really going to scale? You don't have any of the enterprise grade security and all the other things you're going to need later to really do this right. The compliance part and all that isn't there. I'm looking at this and saying, okay, this is a tool, and you're getting people to try it as a tool, but is it a company? And also, is this traction going to stick? That's probably the big one because you're getting all these people and they're signing annual contracts, but are they going to keep them and are they going to renew them? Because they're just excited to try it. That's going to fizzle out. And maybe your core system eventually is going to have this as a feature, or buy one of you guys as and make it their feet, build it in. And then it's like, okay, if there was 100 guys doing AI for law firms, 99 will go away and one will be kind of like the standard. And it
Yeah.
feels like a real, everyone's talking about the AI bubble. And that's kind of my inside take on the AI bubble. I'm seeing hundreds and hundreds and hundreds of startups all pitching pretty cool stuff, getting more and more specific, all for within a very narrow niche within a particular industry. Uh,
Yeah.
like just summarizing medical records for personal injury attorneys. That
Yeah.
was a very specific. I say, okay, that's a great tool, and it saves them a couple hours on each case, and I can see why they would pay you for that because it's
For sure.
they're paying their paralegal, let's say $50 an hour. And if this saves 2 hours, it's saving you $100 per case to press this button. So is that worth $25 per case if they're charging per? Yeah, of course.
Yeah.
Because it's saving you 100. That's a no-brainer. And it's giving you instantly that neat little report. And it's like, okay, yeah, of course you would do that. But it's a tool. At what point do you eventually not need that tool, because it's going to be part of something that you're already using or something else. I don't know. I can't see the future. I'm just scared to invest in these.
Yeah, so it always kind of seems like, AI is sort of, reshaping the way you're kind of looking at your investment strategy in terms of where you focus that kind of attention. So as you look kind of at the deals coming your way, is how do you kind of go about, like evaluating them? Has it changed now when you're starting to look at these tools like, okay, are you just gonna hold off and wait for the next little bit and see, or how are you kind of digging in to really understand, like, do I want is this one AI company the one I want to kind of take that risk with, or do I still just want to kind of stand back and see and wait till the bubble bursts?
Yeah, I'm mostly on that whole genre, standing
Yeah.
back and watching, which is frustrating because it's most of what's out there. So
Yep.
I'm spending a lot of time seeing these pitches, talking to them, getting the decks, and then still not writing checks to most of those in that genre because I don't see the moat. I'm just not investing. On the other side, there's curiosity and pressure for us to integrate AI everywhere, and every tool we use is already integrating AI in some way. All of our vendors are integrating AI, so it's becoming interesting. Every time you log into any platform you use, there's new AI features every day. So it's really exciting as a user to see the AI. And I've been approached by probably more than a dozen already startups that are doing AI for VC that are trying to get me both possibly to invest in them and to be a user of them. They're
Yeah.
trying to say, okay, we have tools to help every part of the business, mostly, filter deal flow, monitor portfolios, all the things, and everything from that to the virtual assistant part where we can do all your work for you using AI kind of thing. And, it's tempting and eventually it will go there. And I not quite sure that any of them are fully prime time yet. Like, I
Yeah.
think scoring deals being trained on thousands of decks and scoring decks is kind of interesting.
Yeah.
I'm not sure that it's quite there. I'm not going to trust AI yet to have meetings with founders and tell me who to write a check to. But, 5 years from now, maybe.
Yeah, I'm curious when you think about, that tool and like where the balance really comes in between technology and like human decision making of, knowing, trusting that all the information is telling you is, aligned with, your investing ethos or like the scores and like levers you're going to give it to measure everything. And then still, do you just go with what it tells you to do? Or like, how do you kind of, I guess, balance the AI data
Right.
inputs with just like human, we'll call
Oh,
like that gut
it's
instinct?
definitely replacing a lot of junior roles, even in private equity and in venture, a lot of analyst roles, making models, updating spreadsheets, even just filtering and summarizing inbound pitch decks, a lot of things that junior analysts would do and then provide downstream to the more senior guys to follow up with. That's a lot of it's being done by AI today. I've seen it with taxes, like, you don't all the work of taking lots of corporate data and then just putting it in the right places in a tax form, in their system. So it's just AI is great at those kind of things, and that's what that minutia that junior people used to do in very long hours, especially during certain times of the year when it's crunch time. You don't need that anymore because all that minutia is being done faster and more accurately by AI. And the AI is not going to make typos. So if it's trained right, it could have systematic mistakes, but if it's trained right and has the right thing, then and then so having the senior people then review that and make decisions and give strategy and talk to the customer and all that's still there. And what they used to have the junior people do can easily be and is being replaced by AI doing it. And I love those startups that are doing that. I love the technology. I just feel like there's too many early stage startups in each one of those fields, and they're not necessarily full on businesses that will survive that. And that's why it's hard to write them checks because that was too easy to build that. So there can be, there's nothing stop. I always say, like, my yardstick for that is what would stop my evil twin from eavesdropping on this pitch and saying,
Yeah.
"That's a good idea, and you built that in 3 months, and you already have 200,000 ARR. Great. I'm gonna take $1,000,000, run up to Stanford, and go find a couple really bright, AI researchers there, comp sci guys that are really on top of this, and say, here, take a semester off from school. Here's $1,000,000. Build this for me."
Yeah.
And then I'll hire a couple really sharp biz dev guys and go sell it to accountants, and I'll be competing with you, and it'll cost me $1,000,000, and in 3 months I'll be where you are. And why are you worth $20 million today?
Yeah.
I can go compete with you. And I
Right.
often ask them, it's like my main question to those startups is, what's stopping my evil twin from building this and being where you are in 3 months? And some have quasi good answers. Many really don't have a good answer. It's more about the trial and error they had to do to figure out what accountants really want. And, oh, my mother's a tax preparer, and that's how I knew what to build because I grew up with it, or some other story like that. But where, oh, well, we have a first mover advantage. It's like, what? You started 3 months is nothing, like, so it really kind of, I feel like, pretty weak moats. And there isn't much of a moat. Occasionally, you find someone who has a really good moat, like they exclusively licensed certain medical data and they had permission that's HIPAA compliant and this and that. And, and it's like, okay, they spent a lot of time and money and got something. They have, maybe one of the co-founders has a unique background where they were in that industry for 30 years and they partnered now with someone that has the AI, and they really, like, say, yeah, know how, and their peers will trust them. It's their former peers. They've been around all the conferences for a particular industry, let's say a certain medical specialty. And then they went out to the resources that say have the data for that and were able to exclusively license, make a deal with them to use their research data or whatever. And that got me in. So some of those I sometimes get really interested in because okay, you have something unique. You have a unique understanding, unique skill set, unique network, and unique data. That's a moat. Your background and connections from decades combined with this unique data, these two kids from Stanford cannot replicate.
And so as this kind of, AI era is moving fast, lots of things shifting, new things coming on the market all the time, are you kind of looking outside of this for like an emerging area that you think more people should be paying attention to?
Another really good question. So, half of everything's AI. It also means half isn't. So, there's still plenty to invest in that's not directly AI. And that's, even though
Yeah.
they're probably using AI, and I hope they are, but I just invested in a startup. I won't name them yet as we're finalizing the paperwork. It's not on our site yet, but they, for example, aggregate a wearable. So, all the wearable devices, they aggregate the data from various wearables to provide them to healthcare providers, insurance companies, researchers, others that need that. And instead of them, like, say you have an Aura Ring, you have an Apple Watch, you have a Whoop, you have whatever. There's hundreds of these devices, and they each provide different type of data in different formats. So aggregating that and then standardizing it and providing it to the guys who want to use it in a standardized format is kind of a low tech. It's a boring kind of data business, but that got my
Yeah.
attention. They had, let's say, already 60 customers using it that were, and so it's like they met all my requirements. And it's a boring business in some way, but it's well needed for today too. These wearables and data and all. And AI is making these devices more interesting because it's giving consumers better feedback, so more people are using it. So it's indirectly AI enabled, but this business is not about the AI, even though they're going to add some of their dashboards to help provide AI insights and all that. But that's a second layer of, what they're going to do down the road with the data. That was an example. There's a lot of things in space tech that are amazing. There's a lot of things in machine vision is AI, but it's different kind of AI. And there's been a lot of innovations over there, and we invested in a few machine vision startups. We invested in, so robotics are big, and I don't like people just making robots, but we have, for example, a company on our portfolio, it's a Canadian company that makes smart joints for robots that can sense force. And it's really more software than hardware. Yes, it's a hardware device, but really what you're licensing is the smarts on the brain in there. It's the software in the firmware in there that makes them smart that really matters. And they have applications in both surgical robots and in industrial robots. Be able to sense, make sure you're not crushing things, but also, on surgery, very important to feel the pressure. That's the feedback that was missing. And surgical
Yeah.
robots is understanding the pressure, the feedback you're getting, like when you're making an incision. And then in industrial applications, understand the weight and also make sure you're not crushing boxes, but has the dual application of understanding how heavy something is and when you're
Yeah.
trying to lift it and how much force you need to be able to lift that weight without crushing it. So that, and they do a great job at that. The demos are amazing. They're live in both applications. They actually had a surgical robot they partnered with a couple years back at FDA approval, so it's really live. But things like that are cool, and you wouldn't even know they exist until you know. So you don't know what you're looking for until you see it, because I would have not known to look for that, but they knew to make it. And there's all kinds of things like that. There's a lot of things in food tech where lab grown meats are coming back and so forth. A lot of things with the blockchain. 5 years ago, everyone wanted to be a blockchain startup. Everyone was trying to force the blockchain in there, and most of the time it didn't make any sense. Now they're all trying to force AI in their name. The blockchain's quietly coming back. It's a great technology, and there's some great legitimate uses where smart contracts on the blockchain can make a lot of sense and are a great technology to solve certain challenges for certain industries. And even in GovTech, helping create transparency and prevent fraud, in third world countries, or even first and second world countries, or certain things. But moving to decentralized ledgers for certain type of records makes a lot of sense, and it's under the radar today. But we're still seeing some. So there's less hype, and actually the ones you see today are more legit. You're seeing some really
Yeah.
good blockchain applications come up where, like, that's a really smart use of the blockchain, and it really does solve a problem. And so there's all these other technologies that are not AI that are still out there and still make up the other half of the startups.
Yeah, I love that. And sort of round out this episode, I'm gonna kind of close out with 5 rapid fire questions for you before we end our time. I would love to know sort of what's your morning ritual or like non-negotiable habit that sets your tone for the day with all these different deals coming across your desk.
Tennis, I blocked that out. So I'm fortunate enough that I work from home, and I set my calendar. I allow others to book slots on my calendar. I use Calendly. There's a lot of other applications. I've been using it for like maybe 6, 7 years, and it's great. But I block out first 2 weeks out or permanent certain slots for tennis and for. I work with a trainer twice a week, but so my personal routines, my workouts, and my tennis take priority. And unless there's an event I need to travel for, those are all blocked out and no one can take them away from me. So you can book any other slot on my calendar. That's fine. If it's empty, Calendly will hand it to you, but my tennis is spoken for. So often it's the first thing in the morning. I'll take the kids to school, go out to the club, play tennis, come back, shower, and then I sit down at my desk.
Yeah, I'm very much similar. My morning workouts are the non-negotiable. What's the best piece of advice you've ever received?
I don't know who this quote's attributable to. You hear it all the time. I violated it for a big part of my life, but it says, if you're consistently the smartest person in the room, you're in the wrong room. And
Yes.
I start to think about that a bit lately because it used to be fun to be the smartest person in the room, but it also gets exhausting. And I'm now uncomfortably, initially, very often in situations where I'm far from the smartest person in the room. And I think that's really when people ask me, what do you like about being in venture capital? My answer is I get to spend most of my time talking to the geniuses inventing the future. And they patiently dumb it down for me because they want my money. So I'm talking to people who are much smarter than me, especially in their areas of expertise, but often in general, they're truly geniuses. And I would not get to talk to them or get to know about this, what they're working on in this new technology, and see their passion for it if it wasn't for the fact that I was in venture. So that's the main reason I actually still do what I do and why I'm liking it, because I don't want to be, I have this fear of being this obsolete, especially the way technology is moving now, be this grandpa who needs his grandkids to come program his remote for him or figure out how to use the technology. It's like, I don't want to become obsolete. I want to be
Yeah.
relevant. I want to be on the cutting edge of technology, and doing what I do is designed to allow me to constantly be on the cutting edge of technology. It forces me to. It's literally my job to stay current on technology and go to conference and study every new technology that's coming out.
No, I love that. What's a book or a podcast that has shaped your thinking most recently or changed the way you think about something?
I recently reread a book that summarized, it went through all however many years, 40 years or whatever, of Berkshire Hathaway's annual reports, and broke it down by categories. So there's a book out there that distills it in a different way, that takes them all and kind of groups them into categories. And hearing Warren Buffett's and Charlie Munger's wisdom over the years repeated, where you saw he was saying the same things like over a 50-year period, was pretty enlightening. There's some interesting takeaways there that maybe, and the patience they have and being okay with just passing on, it makes me calmer, feel much better. Like in this right now, passing on all this Gen AI and not jumping in on the hype, and now passing on the agentic AI, not jumping in on the hype, because that's what Warren Buffett would do. He
Yeah.
would sit on the sideline and say, "No, it's interesting. I'm okay being the only fool that doesn't invest in it, and that's fine." And so I think it resonates with me and helped me feel more secure about what I'm doing today.
Yeah, that's great. What's one investment or innovation that you wish you would have spotted sooner?
Blockchain and crypto. I was pretty late to that party. I mean, obviously, if anyone would have had Bitcoin back when it was pennies or even when it was hundreds of dollars and thought it's going to be where it is today, there would be billionaires from it very effortlessly. And I was pretty late to that party.
Yeah, that's fair. And last and final question, in your own words, define what built for this means to you.
Great venue to get detailed insight from smart business people.
Love it. Awesome. I appreciate you taking time, David. It was so great to meet you and understand more about how you got into the world you're in, how you look at things, and kind of what you see as sort of the exciting pieces, and maybe the misnomers along the way. If anybody listening is curious about how to potentially maybe get involved with your fund or potentially looking, from an investment after even hearing a bit more about you and how you look at things, what's sort of the best way to learn more about you and get in touch?
Right? I'm pretty easy to find on the internet. My personal blog is davidmandel.blog. That's pretty easy. Or even just mandel.blog, it redirects to there. And our corporate website is emerging .vc, so which stands for Emerging Venture Capital, and that has our investment portfolio, our thesis, and the contact us form. So any founders out there that think they might be on thesis, feel free to apply, and we'll take a look at your deck.
Amazing. I appreciate you taking time and look forward to staying connected. Thank you so much.
Yeah, thank you, Jenna.